Okay.
Okay, we can start. C'est bon, it's okay
It's
now.
good. It's fine. Yes, today, SCOR Foundation for Science webinar is dedicated to the consequences of the quantitative easing on financial stability, with a focus on financial institutions, more especially banks and insurance. And behind the word insurance, I have, of course, also reinsurance. This webinar will be hosted by Olivier Darmouni, who is Associate Professor of Finance at HEC Paris, at the Pierre Andurand Chair in Sustainability, after having been Associate Professor at Columbia Business School. Olivier has a PhD in economics of Princeton University. He has been awarded the Best Young Scholar in Finance and Insurance Prize of the Louis Bachelier Institute in 2025, which is a prize supported by the SCOR Foundation. And he has also been awarded the very and famous Nobel Prize in 2024. He has been publishing in the best international academic journals on finance, credit markets, monetary policy, energy transition, and sustainability. Today, Olivier will present us the long-term consequences on financial stability of the changes in monetary policy introduced by the quantitative easing strategy of the central banks since 2008. He will present an in-depth discussion of these consequences at the level of the monetary policies, as well as at the level of the asset-liability management strategy of commercial banks, as well as of insurance companies. I will not prolong this introduction unnecessarily, as I must hand it over to Olivier, who will explain brilliantly, rigorously, and technically the topic. Dear Olivier, thank you so much for having agreed to make this key presentation. You have the floor for 45 to 60 minutes. Your presentation will be followed by a Q&A session of maximum 30 minutes, and the webinar will last maximum 90 minutes. For the audience, please keep your questions for the Q&A session, except for pure question of comprehension. The presentation will be, as always, available on SCOR Foundation for Science website, and probably also on our website. I take the opportunity of mentioning it in order to recommend you to visit Olivier Darmouni website. It's very excellent and will be stimulating for you. Olivier, you have the floor.
Thank you so much, Philippe, for the kind words and the opportunity. I always say that as much as my normal job is being an academic, I'm a professor. What really motivated me to look into research is actually to try to understand better the real world. And so I really value interacting with people that are working in the market, in big institutions, also in policy-making circles. I think this is really the whole point of doing any sort of research, is to have this kind of two-way connection as frequently and as possible. And, on that front, I really want to thank very directly the SCOR Foundation, because, I was fortunate enough to win this prize, and the SCOR Foundation is really strongly behind research to try to kind of improve understanding of the world. And I think that's particularly important at a time where, people are questioning whether research is valuable at all. And so I want to thank the SCOR Foundation for this again. And also, the topics that especially I'm going to talk about today, I think are pretty difficult topic to figure out. I think there's constant flow of questions and conversation that people could have on this topic. And so this is also why I value this opportunity here. I'm going to give you some thoughts related to research that I've done the past 10 years on this topic that's incredibly close to my heart of quantitative easing, of unconventional monetary policy, and how it matters for financial markets and financial institutions, and how, in some sense, have kind of changed the world in these dimensions. But of course, a lot of the things that I'm going to say are not the end of the story. And I would love for us to, have this conversation. So if you have any thoughts throughout the presentation, don't hesitate to put it in the chat, and we'll comment about it at the end of the Q&A. If you think anything that I say throughout is outrageous or wrong, please, I'd love to debate after and love to hear your thoughts. So I see this as a constant conversation, and I look forward to that. So let me delve in right in the slides. I'm going to talk about quantitative easing, think about what it is and the impact that it has on financial institution and financial stability. Now, just a word about me to start. I'm French, of course, and I came back to France this summer at HSC. Before that, I spent almost 10 years as a young professor at Columbia School in New York, and PhD also in the US at Princeton. And one thing that's was important for me was that as I started my PhD, we were still in the midst of this global financial crisis. So left and right, we see financial meltdown, housing crisis, but also deep lasting impact on the real economy, and a lot of policymakers wondering what we should do about it. What can we do to improve the situation? And that's exactly at that point that I was starting my academic career. And so I have this connection with this very practical problem, these financial markets dislocation, financial institution in trouble, and the policy response and the interaction between all of that. So that's why I got interested in quantitative easing very early on, and I'm still am to this day, and devoted already more than 10 years in thinking about these topics. So the structure of the talk will be very simple. I will first define QE as concretely as possible. So far, I've avoided this a bit on purpose, but we'll talk about QE very concretely. And then we'll think about the impact of QE through thinking about kind of the last two major crises, the last two major cycles that the global economy has witnessed. First, the global financial crisis from 2008, 2009 that started in the US and spread elsewhere, and also recently the 2020 crisis with COVID, and that will also get us to think about today and what lays beyond that crisis and the implication of all these issues. So what is QE? What is quantitative? I always like to think about the person that embodies QE the most as being Ben Bernanke. So to me, this is absolutely extraordinary story. I like to try to ask you to put yourself in the shoe of this man, in 2008, 2009. You had a career as a distinguished economist. You're perhaps the most brilliant economist in your generation. You won all these prizes. You're a professor at Princeton. Eventually, Bernanke will get on to win the Nobel Prize just a few years ago. And you decided to go into policy to try to implement some of these ideas in practice and improve the world, and eventually became chairman of the Federal Reserve. And then a few years into your tenure, you find yourself in the worst financial crisis perhaps the world has ever seen, and you have to act. You are perhaps the most important person, most powerful man in the world at this time, as you are chairing the board of governors of the Federal Reserve of the United States, with all the power of the dollar, the power of Wall Street, the connection between the US financial system and the rest of the world. Also, the origin of the crisis is in the US, the subprime crisis in the housing market that spilled over to the rest of the economy and to other countries after that. And, you find yourself in this conundrum that, Bernanke happened to be a very distinguished historian and student of monetary economics and monetary history. And he's doing everything right. He lowered the monetary policy rate to zero, put the interest rate to zero. He's also has done a lot of work that eventually won him the Nobel Prize a few years ago about understanding why bank failures are so bad for the economy by studying the Great Depression. So we're lucky to have him in the driver's seat in this time in 2008 in the US, where he's facing all this trouble in the financial sector, and he immediately understands that he needs to help banks, and he's going to engage in different programs, including some amount of recapitalization that have been controversial, but still he knows are necessary to kind of keep the economy from collapsing. So Bernanke does all of that, and still the situation is dire. He has kind of used all the tools that are understood by monetary policy, and still the situation is not resolved. And so this is the situation that he finds himself about in his office and deciding, what do I have to do next? And it's exactly at this point that Bernanke decided to turn to quantitative easing. So quantitative easing is unconventional monetary policy. This is not the way central banks normally act. Bernanke was not the one who invented or did it for the first time. In fact, the Bank of Japan did it first, but he was really the person that said, this is a very important tool. We need to use it now. And I just want to highlight just how special this moment in history was, because central banking is typically a job about being very careful, very safe, committing to plans ahead of time, being very careful in doing things. But the introduction of quantitative easing, the adoption of this by the Federal Reserve at scale by Bernanke, was really thinking out of the box moment. We need to do something else. We need to try something new. And so that is something that was a big moment. And rippled through the rest of the world, had a big impact on financial markets, financial institutions, other central banks, as I will explain in this talk. So what exactly is QE? I would start by saying that I personally think QE is a very bad name. It's technical, it's confusing, for something that in the end is not very complicated. Quantitative easing is the idea that the central bank will just act as any other investors in financial market. They will just go out and buy assets and hold it on their balance sheet. Typically, this is a direct intervention in mostly bond market. There's a lot of different types of bond markets, so we'll talk about the richness of different types of QE policy. But much better names are bond buying program, asset purchases, and in fact, Bernanke himself was trying to use that language, but a lot of the rest of the community was using the word QE over again. So QE is the word that has stuck. But you want to think about them as, of course, bond buying programs of various forms and shape. Now, I want to stress that this is unconventional monetary policy. You want to contrast this with so-called conventional monetary policy that has been used for many decades across the world, of course. And conventional monetary policy is about setting the short-term interest rates. Typically, banks and other types of prime brokers are able to borrow from the bank. Primary dealers are about to borrow from the central bank at overnight rates. And the central banks decide these rates. And by choosing these rates, they can influence the value of short-term interest rate in the real economy. So this is typically how monetary policy is done. Now, quantitative easing is very different. So let me emphasize two key differences. The first key difference is that quantitative easing is about quantity rather than price. Right? Conventional monetary policy sets a price at which the Federal Reserve will lend or borrow with primary dealers, and that price is going to move the entire market price, because other investors realize that if I can trade with the Fed at this price, then you have to trade with me at a price that's not too different. Okay, so the Fed was, because of that price mechanism, never really end up buying a lot of assets or engaging in tons of so-called open market operations. However, with quantitative easing and unconventional monetary policy, it's completely the opposite. The Fed doesn't really try to target a specific price. They just announce that they're going to buy typically large quantities of certain bonds ahead of time. So it's much more of a quantity mechanism. Then second is a focus on long-term rates over the more traditional focus on short-term rate. Okay, so as I mentioned, traditional conventional monetary policy is targeting an overnight rate for banks. So it's a very typical type, a specific form of credit, very short-term credit within financial institution. The ambition of quantitative easing, and why Bernanke took it out of his hat again in 2008, is trying to have an impact on lowering long-term rates. And not just rates on sovereign bonds like treasury rates, but also on borrowing costs for the real economy. So for example, mortgage rates or corporate bond rate, bank loan rates, any sort of long-term interest rates that affect consumers and firms much more directly than an overnight rates with primary dealer, which is the typical tool of conventional monetary policy. So this aspect of long-term rate is important. It's going to guide what kind of markets the central bank is going to try to target. But of course, it also means that financial institutions are going to be much more important because they are the ones that are active in these asset markets. So the one thing I want to emphasize before we go into more detail is just how prevalent QE is. You look around and you see QE everywhere nowadays. So the first thing I want to emphasize is the scale, how much QE has been done and how much it's completely transformed the functioning of central banks. So let's start with a picture of the US. That's the size of the balance sheet of the Federal Reserve. And you see that since 2008, it has grew 8-fold, multiplied by 8. This is an absurd large number. The central bank balance sheet is now very large. And all of that is coming from the accumulation of bonds through previous rounds of quantitative easing. Now, the second thing so these are trillions of dollars. These are by far like the biggest single investor in any comparable market that the world has ever seen. This is beyond any scales that we've seen before in terms of large investor concentration of holdings. Second, it's not just the Fed and it's not just one episode. It has really spread across the world and is now used as routinely. So the Bank of Japan actually started it. I mentioned that about maybe 10 years before the US started to use it. But the ECB started to use it around the same time as the US during the global financial crisis. Bank of England and others have also now are routinely using asset purchases. Okay, so the conduct of monetary policy has fundamentally changed. And the question that I think is interesting for all of us is, what does that mean for financial markets, financial institutions, and financial crisis? And this is, I think, really where it gets very interesting. The point is that you can't understand quantitative easing if you don't really understand the role of financial institution in financial markets. First, economists sometimes like to think about case of perfect financial markets just as a benchmark. But in that theoretical benchmark where markets are perfectly complete, they're perfectly competitive, information is perfectly aggregated, then unconventional monetary policy doesn't add anything compared to conventional monetary policy. Okay, so the reason why unconventional monetary policy like quantitative easing can be helpful is because financial markets are imperfect. And so you really want to look at that directly. You want to think about the structure of these bond, these credit markets. Who are the actors? How do they manage their balance sheet? Things like that. Okay, so specifically, intermediaries, institutional investors, banks, insurers, reinsurers, mutual funds are holding lots of financial assets and are going to react to this kind of policies. And they're going to do that in such a way based on how they manage their balance sheet and operation, the risk that they're facing, the business model that they're running, and in which market they are active. So that's really a new paradigm for monetary economics. I would say the traditional way to think about monetary transmission, as would typically be taught in like a macro class, even at the PhD level, or the prevailing thinking of people sitting on the board of governors in different central banks, would mostly be about kind of traditional theories of monetary policy that do not heavily rely on the structure of bond markets and institutional investors. And so I would say that what we have learned over the past years is just how important that is. And now we have a much better understanding that it's important to know about these institutional investors when I want to think about the effect on QE, right? And that's a two-way street. These institutional investors, big investors, are going to have impact on how QE matters, but QE is also going to matter for these investors. Okay. So now we want to see this in action by looking at the last two big crises that the world has seen. These are both crises that I've spent some time studying in some of my research, but of course I'm not alone. I'm going to mention other work by other researchers, as well as discussion that have been going on between the public policymakers and actors in financial institutions during these times. So let's start by talking about the global financial crisis. So I'm sure many of us have lived through that and have vivid memory of this. For me, it's always interesting to think about is because I was actually studying in London with a lot of my friends looking for jobs in investment banking exactly at the peak time of the financial crisis, when many people, were doing their internship the summer when Lehman failed, and Wall Street and the financial sector and the city, whether it's in New York or in London, were completely abandoned. And so it was, very vivid memory for me about how the financial sector kind of almost imploded during this time. And what's interesting about this crisis is that, it's the largest thing we've seen since the Great Depression in the 30s. So that was, almost about 80 years later, is that it really started in the US from the housing market. And that eventually spilled over to the US financial sector, that eventually spilled over to other countries' financial sector, and eventually turned into a recession and high unemployment and deep recession across the world. Okay. So the thing that's important to think about here is why does that tell us something? How can that explain the birth or the rebirth of unconventional monetary policy by the Federal Reserve? So you have to imagine yourself again in the shoe of Ben Bernanke, that you're sitting there in 2008, 2009, and you've done everything that the textbook tell you to do. You put the policy rate of conventional monetary policy at 0. You engage in other sort of restructuring of financial institution, and still the economy is really far from recovery, right? So there's a picture here just to remind us how high unemployment rose in the US, which is a country with generally low unemployment, how fast and how high it rose, and how long it took for it to go down. And so this is going to help us to understand how QE works through its first dimension. QE can be used for mostly two things, or has been used for mostly two things. This is the first one, where we can think about QE during the global financial crisis as additional stimulus, right? We've lowered the short-term rates already. We've provided specific facilities, specific capital injections for banks, but still, what more can we do? QE was the answer that the policymakers came up with at the time. The Fed did that, but then all the other central banks followed suit, ECB and others are looking at QE to reduce long-term rates and stimulate the economy to try to get it back to where it was. Now, let's just think specifically about the QE as it was done by the Fed, just to make sure we understand that very concretely. You can look at the Fed balance sheet. I showed you part of that picture earlier, right? This is just the same, but stopped in 2015. The Fed balance sheet increased a lot during this time, where it was essentially very small throughout history before that, or modern history before that. And all of that increase on the Fed balance sheet is driven by bond buying programs. Specifically, there were three waves that the media like to call QE1, QE2, QE3. So we're going to use that terminology. And you can see them here. There's a first spike here, then a second spike here, and a third spike here. These are QE1, QE2, QE3. So, a question that is going to end up being super important is, what did they actually buy? And so for this, you need to think about concretely the structure of bond markets in the country that you're considering. So let's talk about the Fed first, and I'll make a bit of a comparison with the ECB because I think it's interesting and informative. So the Fed bought some treasuries, of course, sovereign bonds from the United States governments, but they also bought a lot of MBS, mortgage-backed securities. So let me make sure we all understand what MBS are. I'm sure in this audience, most people are aware, but I just want to make this crystal clear. These are pools of mortgage bonds. So when people they get a loan backed by the house that is underwritten by a bank, but in the US, this is typically securitized if you're a prime borrower and repackaged into a mortgage pool that is then guaranteed by Fannie Mae or Freddie Mac, guaranteed by the US government, essentially, to turn it into a safe bond. Okay, so I want to say something very important. These mortgage bonds are not the subprime bond. They have nothing to do with the subprime market that exploded, that led to the crisis. This is the opposite. This is the very prime segment of the market that's underwritten by Fannie and Freddie and essentially subsidized by the US government. Okay, so that's the first thing. Doesn't mean that these bonds are completely safe. Of course, in addition to the small sovereign risk, there is duration risk in mortgages. When interest rate change, people have different propensity to refinance, and so there is risk there. But these are not the risky subprime loans. Okay. Now that's going to end up being very important because the financial institutions that hold MBS are going to be disproportionately affected by QE because QE actually bought MBS. Now, another important thing is that this focus on MBS is also important because it's really a US specificity. There's really no equivalent to the at that scale of the MBS market in Europe. You know, what makes the MBS market so large in the US is that the government essentially decided decades ago to subsidize ownership through credit guarantees, and essentially borrowers that are good enough on paper can essentially have their mortgages guaranteed by the US through Fannie and Freddie, which eventually were fully nationalized during this time, just to make it completely clear that in the end, the US government will guarantee any losses on these mortgages as long as the borrowers are good enough on paper to decide. So that means that in the US, MBS are very similar to treasuries. Again, there's this additional duration risk, but otherwise they're incredibly similar. In Europe, we don't have that. There's not the same extent of government intervention in mortgage markets. And so mortgage bonds are very different. And we just don't have such a deep and large MBS markets that's as safe. So because of that, the ECB actually did not buy anything like that. They did sovereign bonds of different countries, but they didn't do anything like mortgage bonds. Okay. Now, vice versa, the ECB didn't have more MBS available, so they wanted to buy different assets. So they actually did buy corporate bonds already in the global financial crisis, also with high ratings, so relatively safe debt from corporation. But the Fed didn't do any of that at that point. Okay. So this is where it's important. QE is not the same everywhere. It depends on the structure of the actual bond market and what's available, and the central bank has to adapt to that. But exactly what they buy is going to matter a lot. That's going to be one of the main findings of some of the work that I've done and others have found as well. And so these are not just details. This is important. What is the central bank able to buy is going to be an important policy tool, right? And that's different from conventional monetary policy, because conventional monetary policy, you don't have the choice. You just have to set one rate, you know, between 0% and 10% or whatever. It's not directed toward a specific market. Okay, so they are the direct intervention of quantitative easing forces you to think about which assets you want to buy. Now, of course, the main question that everybody was wondering about ex ante, but also try to assess ex post, is whether QE actually worked. There, I'll talk a little bit about the evidence. This is a very deep question. There's lots of layers, and what do we mean by working, and which horizon for whom, and things like that. But I will say at a high level, a first finding that seems uncontroversial is that it seems had a positive effect on market and market price, especially in the bond market space. Okay. See that the announcement of QE, we see an increase in bond prices, which is equivalent to a decline in term premium or credit spreads, which concretely means that it's easier for the real economy to borrow long term and potentially invest in things like that. Because the cost of financing has gone down. Now, of course, this is just market price. In the end, we care more about how it's going to trickle down, and we can first ask effect on financial institution, which I'm going to spend a lot of time talking about today, but all the way to the real economy. And then, of course, in the background is, yes, there could be a positive market effect, but is there any negative effect happening at the same time, or that hasn't manifested himself yet, things like that. Okay, so I'll touch on some thoughts related to that as well. So first, I want to focus on a study that I did with a co-author of mine, Alexander Rodiansky, where we look at the effects of quantitative easing on bank lending, not just on financial market. We were thinking about, okay, maybe the market react positively, but is that going to have any spillovers on institution and the real economy? So we looked at banks, because banks do a lot of lending, but also banks are big investors in MBS. So, you know, it's interesting, of course, that The bank business model is more simple than just saying they take deposits and they make loans. They also have assets on the balance sheet, okay, typically safer liquid assets. And they are actually bonds. And in the US, in fact, most of these bonds are MBS. They're not treasury, okay? Maybe that's not a fact that I think everybody knew, but this is definitely the case. In Europe, of course, we don't have MBS, so sovereign bonds are a much bigger share of the bonds that banks have. And so what happens when you engage in quantitative easing? Well, as we saw, the market value of these bonds go up, which for banks is helpful because it's going to boost the market value of some of their assets. And that's going to work like what some people have called at the time, like stealth recapitalization. Well, now you kind of improve the value of the bank, and that's going to relieve some frictions and help the banks potentially lend more. And this is what we see in the data. This is what our studies suggest. Banks that have that are more exposed to quantitative easing, that benefit more from these increase in asset values, are going to lend disproportionately more. Now, another big financial institutions are insurers, of course. And here I just want to cite a study by someone that I co-author on another research project, Gabriel Chodor-Reich from Harvard, that has this very nice paper that shows convincing evidence that QE also benefited insurers during this time. And that is not so obvious because, of course, insurers, because of their their asset liability structure, for instance, a lot of fixed rate long-term liabilities, lower interest rates might not be such great news in that respect. But still, he finds evidence that insurers benefited during this introduction of QE in the US. And this is kind of related to a financial stability channel. He finds that, again, there's a similar channel of increase in asset values, and that led to decrease in funding costs for insurers and a decrease in default risk. And so kind of that was very welcome stimulus, given that insurers were going through difficult time, impairment on the balance sheet, and that this QE market stimulus was actually helpful for them during this time at this point. Of course, when you think about very low long-term rate for a long time, this is like a different question. Now, that doesn't mean, that QE is perfect. It seems that it has a measurable positive effect on markets and some financial institution, at least at the time when it was introduced in the US. But there are some important limits to keep in mind. So let me mention three. You might probably come up with both, and I would love to discuss some of that later on as well. So first is that the first announcements tend to be very potent, but that later announcements are kind of less impactful. I think this is reflect a key point that there is some sort of market expectation changing as the government the central banks start to introduce these programs. Like the first one really comes as a big shock. It's like, wow, I can't believe Bernanke did that. I can't believe the ECB is following suit. I can't believe they're putting all of this money into these markets so quickly. But then once you've seen it, in some sense, it's become less surprising and maybe you anticipate a little more. Okay, so there could be some issue with ratcheting that I'll come back to later. Second, another limit that I pointed out is that what you buy really matters, and that's because there's some amount of narrow effects. In some sense, if you buy more of bond A rather than bond B, you can have more effect on the market for bond A than the market for bond B. And I'll give you one example of that related to the study I did on bank lending. One key difference between the three ways of QE, QE1, QE2, and QE3, was that QE2 only focuses on treasury. I emphasize the role of MBS, but actually MBS were only done in QE1 and QE3. That ended up being a big difference for the impact on net lending because banks actually don't have a lot of treasury. So QE2 was not very stimulating for them. And in fact, in the data, we see that the impact on lending of QE2 specifically was much smaller than QE1 or QE3. So what you buy kind of really matters. And in some sense, it's unavoidable because if you remember, the new paradigm for monetary economics is that their markets are imperfect. They are somehow segmented. If they are not segmented, if markets are perfectly integrated, then QE doesn't really matter. You can just do conventional monetary policy. But if markets are fragmented, that means that effects are bound to be a bit narrow, right? That if I buy of a specific bond as a central bank, the effects are not going to be perfectly transmitted to all of the bonds and all of the markets at the same time, right? Because there is imperfect integration. Okay. So that makes sense, but it's incredibly important in practice. And central bank always have to figure out very quickly, what do I buy and how much do I buy? So the more we can understand these narrow effects, the more we can help them on guide their policy towards buying the right composition of assets. Now, the third thing, and this was not so much something we worried about at the beginning, but now that QE has been so widely adopted, is really a salient potential issue, is the increase in bank reserves, because the central bank has to pay for the bonds that they buy. And how do they pay? They pay in bank reserves. That's how the central bank pays. That's the equivalent to the dollar for the central bank. And the issue is that these reserves have to be held by the banking sector. And so as QE increases, the amount of reserves in the banking sector increased a lot. You know, the same amount of increase that we saw in the Fed balance sheet is mapped one-to-one by the similar increase in reserves in the banking sector. And the issue is that that amount, astronomical amount of reserves, can start to potentially crowd out balance sheet space for the bank and potentially stifle lending. And there have been a couple of insightful research papers that try to document that in details in recent years. So that's something to worry about. That, of course, initially when QE was just getting started, was not such a big deal. But the wide adoption of QE makes this a potential important limit. Okay, so now I want to talk about closer to us, the 2020 crisis and the revival of massive QE policy across the world, and how to think about what happens beyond that and what it means for today. So I just want to say a word about the 2020 crisis. This is something that I studied actively. You know that as I was a researcher working on other projects, I saw this happen in front of my eyes. And of course, a lot of the work that I've done on previous financial crises was directly relevant to understanding this episode. And so I wanted to kind of adapt the thinking and see what we can say about this episode. So it ended up being incredibly interesting to understand from the point of view of financial markets, because I'm sure most of you remember where you were or how it was, where you were stuck during the pandemic. March 2020 was special, at least in the US, because of course the outbreak has been going on for a while in China, but most people, most commanders were not sure this was going to have a significant effect on the US economy. But by March 2020, it becomes incredibly quickly clear that it's going to paralyze not just the US economy, but the global economy for a certain amount of time, in proportions that that few people saw coming. And so that had a tremendous effect on the financial sector. And that's interesting because this was not a financial problem, very different previous crisis that was triggered by mortgages. This was completely outside. This was about uncertainty over global supply chain, inability to travel, people having to stay at home, not being able to travel to the store, and things like that. But yet that generated a massive market turmoil, specifically in bond market. And one market that was hit very hard was the US corporate bond market. So I'm showing you a chart of this on the right. And I want to emphasize just how sudden this crisis was. We kind of never saw anything that quick really before. So the yellow line here on this graph is plotting the spread on US high yield corporate bonds. So these are loans made by the market to firms. These are high yields, so they're not the best rated firm. And what we see is that the spread is typically around 400 basis points, 4%, but that it kind of reached the level of like 10%, 1,000 basis point very quickly from February to March. So this is really a matter of days, weeks at most, when we see this incredible turmoil in financial markets. And that is very worrying for financial markets and every type of market participant and the central bank as well, because this is a time of high uncertainty. It's a time where firms might face cash flow shortfall. And so they might really want to borrow during this time to ride this wave. But exactly at the time where they might have a high need to borrow, the cost of borrowing, and by the spread here, skyrocketing. And so this was extremely concerning, but the financial sector kind of amplified the initial shock and lead to a disaster for the real economy. What's interesting is to unpack also the role of institutions in precipitating this financial crisis here, the role specifically of mutual funds. So I want to highlight this in the other parts of this graph with the gray bar. Mutual funds, of course, comes in many sources. These are big institutional investors that hold bonds on the behalf of their investors. Some of them retail, some of them institutional. But they're not, again, part of the typical picture when you think about monetary economics or central bank conduct. This is not something that is taught in macro monetary courses or is debated that much in normal time in central banks board when they got to decide on policy. However, during this time, this financial institution ended up being super important. In particular, they experienced massive outflows exactly at the time in which spreads were skyrocketing. So again, within a matter of days or weeks, you see these very large negative bars here, which are about money coming out of mutual funds. So these are investors like you and me and others, institutions, that just decided to take their money out of corporate bond fund and put it in safer investment vehicle. Okay. And of course, what happens when a mutual fund has money coming out? Well, they need to repay their investors, and so they need to sell some of the assets, some of the bonds that they hold. And as you sell bonds very quickly, and a lot of them, the price of this bond is going to collapse. And equivalently, the price of bond collapsing is the spread, the credit spread on skyrocketing, which is exactly what we see here. So this particular cycle led to a new revival of QE, and that came in a different form. So in two ways. First, this was there was the beginning of corporate QE, where the point was really to target the segment of corporate debt markets that were undergoing turmoil. So for the Fed, that was the first time ever that they announced that they will buy corporate bonds. The ECB, as I mentioned, they already bought some before because they don't have an MBS market, but this time they bought specifically targeting this market. And so that's interesting to look at this other episode because it shows you a second way QE can be used. Now as an emergency measure to address kind of disruption in a particular financial markets. Well, before it was much more about kind of additional stimulus, more of a medium run approach to try to stimulate the economy broadly. Okay, so these are complementary but different in terms of objective. So I did some particular study trying to understand the central bank purchase or QE in this particular episode of corporate QE during the 2020 bond market turmoil. And there, the importance of financial institutions is very clear. So the starting point is there are these mutual funds that are more fragile bond investors that hold the bonds, invest in bond on the asset side, but the liabilities are usually demandable equity shares. And so investors can take their money out, redeem their funds pretty quickly and to put it somewhere else. And so that's what happened. We saw a lot of outflows, people taking their money out from these mutual funds. But then to pay back investors that are asking for their money back, you need to sell bonds. And how you sell bonds, that creates selling pressure on bond market that is going to reduce the price of the bonds. But then you get into this, this vicious cycle that if the value of bonds go down further, then the returns on the bond fund will reduce even more. And investors see now that their portfolio has worse return, that makes them even more want to sell even more shares and redeem even more. And so that leads to an additional round of mutual fund outflows that then is going to lead to more selling and a more price decline. And so that leads to a cycle of price decline and outflow that led to kind of the very quick crisis that we saw in corporate bond market of massive outflows and massive increase in spreads. Now, one way for the central bank to break this spiral is through quantitative easing. Right? You can just start to buy some of these bonds, and that will directly alleviate some of the selling pressure, right? And if the market understands that you will buy enough to prevent the price from collapsing too much, then suddenly a lot of the reason to take your money out of these funds disappear. And so the quantitative easing can also break this spiral and improve financial stability, okay? Reduce financial fragility. So that is a big part of what happened when the announcement of QE, of the new corporate QE happened in the US. Clearly, we saw reversion in inflows and improvement in bond values. Okay. Now, I want to say a word about insurers and other, similar institutions active in these markets that tend to hold corporate bonds. Now, these are interesting because they are not at the core of the crisis like mutual fund because their funding is much less fragile right? No one cancels their life insurance policy because bond returns are down, right? That just doesn't happen very much. So insurers are a big source of stability for these markets. However, they have a bit of a limited issue to intervene and break this spiral themselves. That's why the central bank is helpful, because we do have some evidence, though, that insurers did buy some of the bonds that were sold from mutual funds during this time, and that was helpful from a financial stability perspective, but there's some limits to that, okay? One of them, for example, is just, insurers and mutual funds tend to cater to different segments of the market, right? Insurers have, for different reasons, tend to prefer a little bit long-term bonds, safer bonds, because of their business model, the structure of their liabilities, but also different type of regulatory constraint. Well, mutual fund then kind of cater to the rest, like more short-term, riskier, like high-yield bonds that insurers maybe at the margins don't have the same preference for. So that's all good and nice in normal time. That's a good, efficient way to segment the market. But in bad times, that create issue. It means it's hard for an insurer to just come in and buy all these bonds from mutual funds because these are not your favorite bonds to begin with. And so this is where the intervention of the central bank is particularly helpful in restoring financial stability fast. So I can summarize a little bit the effects of corporate QEs on different agents. On financial institution first, mutual fund, clearly very beneficial for mutual fund sector, like incredibly beneficial, boosting asset value, money came back through inflows very quickly after the announcement. And so, I want to say, like, this is probably good for financial stability, but it does look a little bit like a very diffuse, mutual fund bailout. In the end, that's kind of what it was. In the previous financial crisis, we had kind of much more explicit bailout to some very big banks through things like the TARP program. Here, this was much more diffuse. You essentially kind of bail out mutual fund investors through these big purchase programs here. I mean, that's not necessarily a bad thing. There's a upside in restoring financial stability, but nevertheless, going forward, this can have some cost for investor behavior and risk taking and so on, like all other bailouts before. So I think, we should not think necessarily as quantitative easing not having some element of transfer. I think they do. Okay. Now, if we think about insurers, this is a little bit more interesting, a little bit more subtle. I think insurers did benefit for sure of the boost of asset values because they hold a lot of these bonds for the long term, and so they were able to see this boost in asset value after the intervention. But for them, there's a bit of an opportunity cost as well. In the sense, as I mentioned, some insurers did go in and buy some bonds, and that was a good trade. That was a good trading opportunity because these bonds were trading currently at a very low price because some other investors were desperate to get rid of them. If you're buy and hold, this is exactly the kind of stuff where you'd like to go and dip in a little bit and buy some of these bonds on the cheap and hold them for a while. Okay. Now, of course, the central bank coming in kind of makes some of these trading opportunities disappear. Maybe the insurers are not the most natural arbitrager. There are smaller funds that were, maybe more likely to make a lot of that arbitrage, but still, this is something to think about. Then I just want to say a few words on the firm side, because this is something that's close to my heart. I did a follow-up study on how it affected firms. The market certainly rebounded very strongly after the intervention, but what did firm do? Well, first, they raised a lot of money. They issued a lot of debt during this time, and probably that sounds good because this was a period with a lot of uncertainty, and so that could be helpful. However, when you dig into exactly what firm did with the money, you see that it's not as directly positive as maybe you might have hoped. Specifically, the firms didn't really use this fund directly for investments or employment. Instead, the money was mostly used to increase cash or repay old bank debt. So this is not bad. I mean, having a firm that is better liquidity position is helpful to maintain investment and employment, but certainly it's not like every dollar that was spent on QE on the bond market implied $1 that firms used for investment. That certainly wasn't as easy as that. And of course, it's because of the nature of the uncertainty shocks that firms are facing during this time. Okay, I think that's important to think also beyond financial market institution, all the way through firms and consumer whenever we can for the impact of QE. Okay, so what do we do with it now? We've seen almost 20 years of massive QEs across the world. I think there's a few lessons that can be taken from that, and still lots of open questions. One lesson is that central banks are now, de facto, whether we like it or not, key players in bond market. And I think that has shaped market expectation. I think markets now come to expect that if the situation gets bad enough, the central bank will intervene in some markets in bad times. So that feels a bit like a quote unquote policy rule, in the sense that people understand when, in which cases the Fed is likely to intervene in the form of QE. So that's interesting. I use this word policy rule because this is a very old school notion for conventional monetary policy. This is something that's been debated for decade in the context of interest rates setting, that the central bank should have a rule that it can commit to, that the market can understand. So it really in order to guide expectation. Well, I will say that, for unconventional monetary policy, the central bank was very reluctant to do that at the beginning because it was so experimental. I think even today they are very reluctant to kind of formalize this rule, but I think that implicitly this rule is there and market participants understand that. Okay, so I think clearly what's happening now is this anticipation, of intervention in bad time leads to boosting prices ex ante even in normal times. And then exposed when there's an announcement, the market doesn't really move that much anymore because it kind of anticipated it. Okay, so it doesn't mean that QE necessarily has a lower transmission. It just means that a lot of that is already priced in normal times. And I think this understanding that there's a bit of a policy rule implicit in central bankers, that they will intervene if things get too bad, makes long-term and riskier bonds safer than before. At least in the sense that it insulates them from financial shock and turmoils in the financial sector. Whether that's good or bad, there's pros and cons. The financial stability implications are probably positive, but we can be worried about other downsides. Now, one thing I'll emphasize is that this idea of anticipation creates the risk of a ratchet effect, right? Now that I understand that if there's another crisis coming up in 5 years, the ECB or the Fed will buy lots of bonds. That means that their future announcement will not really change the price very much. And so if you want to improve prices going forward in bad times, you might have to buy bigger and bigger and bigger and bigger amounts to kind of work against this expectation, keep surprising the market. In the US, this is a particular striking example of this ratchet effect. If you remember, in April 2020, the Fed did two types of QE. They did a corporate QE that was completely new. They never bought corporate bond before, and we talked a little bit about that. But there was also some problem in the treasury market, so they did some much more traditional treasury QE. And interestingly, the first new program had a very large effect on the market, so much that the fact in the end, the Fed didn't really have to buy very much. They bought maybe 5% of what was the max of what they were willing to buy. For Treasury, it was the opposite. The announcement has virtually no effect on the Treasury rates, and they had to actually go there and buy more and more and more to bring the rates lower, very slowly. And they end up spending more money on this last round of QE than they spent in any previous of the 3 rounds of QE in the great financial crisis in just a few months, just because they had to kind of work against this expectation that was already priced in. Okay, so I think we're already seeing the ratchet effect at play. And now going forward, I think it's very strongly there. It's going to be very hard to get big announcement effects for programs that were has already been implemented before and the market anticipated. In some sense, that means QE is kind of a victim of its own quote unquote success, that everybody believes the central bank will keep using it going forward. So the last thing I want to talk about is potentially the end of QE, which is quantitative tightening. So you might have seen that in recent years. There's been a willingness of central banks to reduce the size of their balance sheet, and that's what QT is, quantitative tightening. It's just stopping purchases or even directly selling bonds that you bought before. Now, there's always some concern, and I remember talking to Bank of England governors about that in person, about what's going to be the market reaction, or the market's going to freak out. Because there was an episode a few years back during the global financial crisis of taper tantrum, where the market kind of thought the support will stop, and that create a lot of negative market reaction. But I think that right now, after all these years, we understand sufficiently well that QE is supposed to be a counter-cyclical tool, and so it should decrease in good times. I think market can understand that. And that's, again, the value of being a bit more explicit about this policy rule. If you can do that, if you can communicate properly, QT is about following the rule. It's not about breaking it. And so there's no reason for a financial market to freak out if you're following the rule that you laid out. Okay, so I think if properly communicated, QT, like we see happening right now, is going to have very limited risk for financial institution and financial stability. In fact, my reading of all the QT that's happening recently is that it's been pretty orderly, and certainly it's kind of this very asymmetric effect. The first Q is very positive, but the first QT is not going to be very negative, because I think there's this thinking about state contingent policy. So I'll wrap up here. To me, I think unconventional monetary policy is no longer unconventional. It's just the new normal. The zero policy rate is going to go to zero if we have a crisis. The central bank will restart some asset purchase program of the like that we saw before. I think this is most likely to stay. I think overall, my assessment of the evidence and different episodes across places and time is that Q is mostly beneficial for financial stability. I think some of the initial concern about financial stability's negative effect of QE didn't really come to fruition. Now, it doesn't mean that there's no downside of QE, of course. I think the most interesting for us is that it forces us to think about a new paradigm of how monetary policy works, and think about large intermediaries and institutional investors. So banks, of course, that are featured prominently in the global financial crisis, but also, of course, insurers, mutual funds, reinsurers, and other types of large institutional investors. This is really something that central bankers now are starting to think really hard about, the structure of the financial sector. It's not just a veil, or it cannot just be simplified away like in most classical macro monetary textbooks. That also means that now the financial markets, the institutions and the investors are closely watching what the central banks are doing. And any sort of interpretation about policy shifts can have big impact on market. I will end by saying the reverse, that now I think what's happening in central banks is definitely very important. Normally, central banks are reacting to turmoil in financial markets. That's mostly what we've seen in the past decades. But now I think, especially in places like the US, there are some question of what's going to happen inside the central banks and big changes there. And, if you're nervous about how the central bank is going to work, I think because of the big impact of QE, that also make you nervous of what's going to happen in the markets. Thank you very much. I look forward to any comments and thoughts that you have now.
Thank you so much, Olivier. It was very, very interesting, very stimulating, raising a lot of questions, not only for those on the asset side of the reinsurance company, but also for those on the liability side of our company, because mostly of the fact that we use in some or the other way the sovereign interest rates, the interest rate, the bonds, the sovereign bonds interest rates as a proxy of the risk-free rate. Surely we have never considered corporate debt as a risk-free debt, but sovereign debt has sometimes been considered as such. And therefore, all this question of the quantitative easing is central in our analysis of the financial risks, of course, of the sovereigns, but also as a consequence concerning corporates and, by definition, mortgage-based securities. And just to let you know, there is not many weeks when the Ministry of Finance was putting pressure on insurance company in order for them to invest in private corporate debt. Not sure it was or it is the most secure recommendation, but of course the private debt has is not considered currently for the quantitative easing. but nevertheless, the rated corporate debt is, and therefore we should remain very, as you said, very scared and very, very attentive, with a lot of attention on the consequence of the quantitative easing on their pricing, their valuation, etc. But it's not up to me to ask the first question. Please, I turn to the participants. There you have some question. Don't hesitate. You have two ways to ask the question. If you are too cautious, you can send a message and I can read it. Otherwise, and it is my recommendation, I recommend you to ask yourself by yourself the question. Just you raise the hand and I give you the floor. Please don't hesitate. Hello, I see Carole. Carole de Rosière, you have the floor.
Yes, thank you very much for this presentation, very clear. I think as you said, we were kind of used to this huge program of quantitative easing, both in the US and in Europe, a few times over the last decades. But is there, from your point of view, isn't it a kind of soft limit to this capacity of QE from the central banks?
Yes, for sure. So I mean, there's multiple ways to approach that, but I think so sometimes I like to joke that QE is a bit victim of its own quote unquote success, and it's been used a ton. So I like to give this example. For example, in Europe, the ECB is facing that very strongly in the sense that it wants to buy sovereign, would like to buy a safer one, but there's only so many Dutch bond to go around before the ECB starts to corner the market, or even corporate debt. Actually, having them started to buy corporate bond, and the ECB has started to buy corporate bond much earlier than the Fed already in 2016, and now they start again in 2020. And now the ECB owns something between 25 and 30% of the whole European corporate bond market, and this is an incredibly large amount. Of course, the corporate bond market is smaller in Europe than in the US, but still. So when you get to these levels already, you ask yourself, okay, are market forces still at play? And, this is way too much concentration. So I think there is that first limit, which is just the size of the market, that if the central bank starts to be too big, then it's not clear that there's not going to be too much distortion. Then the other thing is just once the deficits of government starts to be so large, like it is now in Europe or in the US, then again, having the central bank being always, very large marginal investors mean that you get very close to integration between the fiscal authority and the monetary authority. And when you get to that point, that is not usually super desirable for stability. We have plenty of historical experience of monetizing debt experiments that didn't work out very well. So that's another issue. If the central banks get into these areas, I think this can raise a lot more question than it can start to help. So that's a limit. In addition to the main one just being that if everybody anticipated, then the action is just not going to bring a lot of new extra oomph, a lot of big reaction unless you really scale it up like crazy again. But then we hit all of these problems of cornering the markets and kind of subsidizing the deficits way too explicitly. So I think we are almost at, it's hard for me to imagine that we can do a lot more than what has been done, especially 2020 has been way more than I think anybody anticipated. So I don't know that we can do a lot more. That doesn't mean they should not keep doing what they have done, but just try not to scale it up, another notch. I think that sounds maybe a little bit too dangerous. That's my 2 cents.
Thank you.
Thank you so much. Are there others? Please don't hesitate. Don't hesitate. in order to give time to everyone to formalize your question, I have a small question, Olivier, which is coming. You did deal with it, but very quickly. How much can we expect central banks in the future to extend the focus of the quantitative easing to other kinds of assets? For example, of course, currently, maybe the debt of some companies, the private debt, non-quoted debt of companies invested in artificial intelligence. You remember Gita Gopinath, which was the chief economist, formerly, previously the chief economist of the IMF, has been raising the question of the artificial intelligence bubble burst and the comparison with the dot-com. Of course, if it creates huge consequence on unemployment, on GDP, etc., is there, do you think, a limit, a frontier, which would stop the central bank entering unknown territories of intervention in terms of category of assets for the quantitative easing?
Yeah, it's a great question. I think, speculating on what's the next crisis going to come up from is always hard, but I think the evidence suggests that, yes, I think this was a little bit why I highlighted Bernanke to begin with. I think that was kind of the breakthrough moment, that Bernanke was like, we should be willing to try something else. And I think that really resonated in the end, given how well it went, with the US buying in the end very plain vanilla thing, right? Treasury and MBS being very close to as close as it gets to plain vanilla. Then the subsequent venture in corporate bond by the ECB also felt like it was not, it was working well in terms of market reaction, at least. That led the Fed to be more willing to do a corporate QE in 2020. I think all of that comes together, and now it feels to me at least, that policymakers would be pretty comfortable with trying different asset classes if there's a particular issue with that market. I think they are more willing to do that than before. One example is that when you look at how the Fed was explaining in 2008, they were saying that they're buying the safest stuff, Treasury, MBS guaranteed by Fannie and Freddie, maybe some agency debt, stuff like that. Very clear about the fact that these are very simple instruments we understand very well. But then in 2020, to stimulate the corporate bond market, they say, well, we can buy corporate bonds and maybe we can buy investment grade, but there's still this question, like, is that going to help enough firms? Because the investment grade firms are the Apple of the world, do they really need our help? And so you see something kind of extraordinary that in the US, I didn't mention that explicitly, but part of the corporate QE package was to buy high yield ETF. That's a very exotic instrument that I assume most people in this room, even if you are sophisticated investors, you will not necessarily hold. These are, exchange traded funds, so it's a very, rising class of assets that try to do all the transfer in kind to avoid all this liquidity issue. It's a complicated structure. And they are active in high yield bonds, as they are, of course, most active in equities. But the Fed actually bought high yield ETF. And so this is, I always joke and call this unconventional monetary policy, right? This is very far from a mortgage-backed security or a treasury bond in order to understand kind of this particular market. But they felt the need to intervene that because that's where the fire was, right? It was corporate credit, and they wanted to reach riskier firm. And it was a complicated equation for them because they don't want it to be too risky. They're very averse to credit risk, although it's unclear that the balance sheet, the Fed, can't sustain some sort of default risk, maybe better than financial institution can, but still it's kind of so they did, instead of buying a high yield bond directly, they bought ETF, supposedly because they're more liquid, perhaps. But that to me was kind of it was not a big part of what they bought, but I think is a very clear illustration that they are willing to invest in kind of exotic assets. And we came a very long way from the initial treasuries and sovereign bonds. So when the next crisis hits and another market is in trouble, I can't imagine that the central banks won't even at least consider buying some of that things directly. They are worried about execution. They don't want to feel like they're being scalped. And so they tend to prefer public market to private market, but still. My feeling is that I'd be surprised that they wouldn't at least consider it at the end when it comes to that. But the will to experiment is really kind of the Bernanke legacy that we have to live with for the coming decade, perhaps.
Yes, it is as in strategy, you are testing the frontiers, the limit of your strategy at some point in time.
Yes. But that's the opposite of traditional monetary policy that is all about committing to very conservative, predetermined rule. And so this is why this is a different world that is so interesting to study.
Sure. I see that Jatin Patil. Jatin, you have a question. Can I invite you to present your question, or do you prefer me to ask the question? I would prefer you presenting your question and your argument, if you agree.
Yeah, sure. My camera is not working.
It's not a problem. Don't worry.
Yeah.
We hear you very well.
Thank you. So my question is that, apart from the quantitative easing, what else, the methods can be used for easing financial stability? And if, apart from quantitative easing happened, what were the methods that we were relying on traditionally, and what methods, do you foresee that we can use in future apart from this method?
That's a great question. Really, thanks for raising that. That's something that actually in the last study I mentioned, we spend a lot of time kind of thinking about. So let me backtrack a bit historically so that can put QE in context and your question in that context. Historically, the central bank has done two things: set monetary policy rates for stabilization, but also be banks of banks. So lender of last resorts. So if a bank had issue, they could borrow liquidity short-term from the bank against collateral, right? Think going back to Beijing, at least. These are these two pillars of central banking. Now when I'm talking about QE and financial stability today, I was kind of hovering between the two. And in fact, I argue that quantitative easing can work as both pillar. I mean, the great financial crisis is more about the first pillar, about lowering rates, stimulating the economy. And the 2020 episode with the corporate bond market turmoil and the mutual fund crisis was much more about trying to be a lender of last resort in some sense of preventing spirals in the financial sector. However, if you notice, buying bonds is not at all being like a lender of last resort. So I think one thing that we can think about, as you ask, is, can't we also innovate, not on the monetary policy side, but also on the lender of last resort? So specifically now with the rise of non-bank financial intermediation, with a bigger role of insurer, reissuer, mutual fund, does it not make sense to think about extending the central bank lender of last resort power to non-banks? Because currently it is not possible in the baseline, absent any other change, for the central banks to lend to things that are not closely associated with banks. However, in crisis, we've seen some facilities being created to lend directly to money market funds or other types of institution. But of course, they always created in the midst of the moment, usually require some sort, at least in the US, some sort of call to very specific exemption. In Europe, often scrutinized by, for example, Karlsruhe, the German Supreme Court, to make sure this is actually legal. So I think, going to your point, one of the general messages, my message is that QE can be impactful because markets have grown so much and banks are not doing all of the stuff right now. And so because of that, yes, we can expand the scope of monetary policy from going from short-term rate to buying a long-term assets, but we can also think about expanding the role of lender of last resort, which means lending directly to non-bank financial institution in a kind of much more predictable way, right? So if you remember, the thing about banks is that a lot of people have confidence in banks because they know that if there's a short-term problem, they can turn to the Fed. They know that in advance, and so maybe they don't run on the bank so much. But for non-banks, it's not so much like this, because there's uncertainty whether the Fed will be able to lend to them, because every lending program to a non-bank financial institution has to be created from scratch in emergency, and you need somehow someone to sign it off on this. More structural ways to provide financing to non-banks is an important alternative to QE. But what's interesting, and is the last thing I'll say, is that QE kind of works as indirectly a lender of last resort for a lot of these NBFI that are active in markets, right? So think about a corporate bond mutual fund. If there's a run and money comes out, you can lend money to them. That would be lender of last resort. That doesn't currently exist in the US. That's not legal. The central bank cannot lend directly to a mutual fund, but they can buy some of their assets and boost the value of these assets. And that kind of works kind of similarly. So I think your question more generally is unconventional monetary policy can help by acting on the asset side of institution, but historically central bank has also acted on the liability side. But only restricted to banks. And so perhaps we can think more about that. And there's lots of good question about complementarity between quantitative asset purchase program and more direct lending program or lender of last resort program for these big financial institutions that are not banks, like some of them that we discussed today. So I think this is potentially very important. I will say, as much as we discussed QE, the willingness of central banks to use these tools, I think these other tools like special facility to lend to non-banks have also grown a lot and happen very frequently in crisis. So I think people maybe expect that to happen a little bit more, but this is again something where it'd be useful to be more clear ex ante ahead of time that this can be there to kind of help the problem before it arises. So that's one thought I had on that. Thank you.
Thank you. Thank you. That explains. Thank you.
Thank you. I see that Darren Thury has a question. Please, Darren, you have the floor. We don't hear you. You are on mute.
Thanks, Philippe. Thanks for the presentation, Olivier. I just have a question around quantitative easing and lenders of last resort. Can it create perverse incentives for financial institutions where, they take more risk than they otherwise would, knowing that they can be bailed out if things go wrong? I think that would have kind of come out from the great financial crisis. We've kind of seen it in the last couple of years as well with some scandals or banking crisis.
Yeah, absolutely. So I think this is why I feel strongly that quantitative easing, no matter how you want to label it as a market liquidity intervention or financial stability, does work like some amount of diffuse bailout of investors. And so we should think about the potential distortion of incentive like we always worry about bailout distorting incentives after bank bailouts for banks. So I'm not sure that banks themselves are the ones that are the most affected by quantitative easing. It might be other kind of less regulated part of the financial sector might be even more prone to changing their risk behavior, presumably also because they're less regulated. And so there's less ability to monitor whether they take risk. But yes, I think in general, I think going all the way to scandals and fraud and like blatant risk management is a little bit of the extreme. It's like the tip of the iceberg, right? I think at the macro level, we should probably spend more time to understand how much, more reasonable, smaller scale, but still adding up distortion in risk are being taken by that. I do think that, yes, there's some potential there, but it is a little bit the goal of the policy at the same time. And we are always wrestling between this trade-off between like credit stimulating markets that perhaps are constrained by financial frictions, by imperfect information and things like that, and too much risk taking. So clearly now, I think a lot of bond markets anticipate lots of QE going forward in the bad state of the world, and that kind of compresses the spread on bond markets. And so you have incentives to go into other asset classes as an investor or as an institution that are riskier. And maybe some of that is good because you're making loans to the real economy, but if it goes too far in the chase for yield, perhaps this is seating the growth of the next crisis. So I think this is the line of thinking. The worry you raise was debated ad infinitum almost for banks during the great financial crisis and the big bank bailout. I think less directly about QE. I think there's a lot of conceptual concern. In practice, we haven't yet really find a way to put our finger on it. So my feeling is that yes, probably, but in a very diffuse way, and that might only play out in the medium long run. Of course, with some of the scandal and smaller exception that you talked about. But yes, I think people understand that these bonds are going to be cushioned, and that changes your incentive perhaps to take risk. I think we should think about that more carefully. Yes.
Thank you.
That is, Olivier, if an actor is able to get a systemic dimension, then of course we could interpret the quantitative easing as a kind of bailout commitment for those kind of actors. Not necessarily uniquely the banks, but other actors may be also sources of systemic risk, as we have seen over the last years.
Yes, and the typical way to do bailout is to inject fund on the liability side through a recapitalization or a subsidized lending program. But interestingly, quantitative easing has a bit of a similar effect, but the transfer happened more on the asset side by boosting through government policy, the value of the asset. So it's perhaps less explicitly a bailout, but it does have the same transfer effect. And economics is all about why sometimes some transfers are good. There's some good side to them, like preventing financial meltdown, perhaps, but there could be a downside in the sense that, the price signal is distorting and incentives can be distorted.
Exactly.
And so we used to think about that for lending program, for a recapitalization program, but for quantitative easing, I think historically people have been very reluctant to explicitly study that carefully. But now I think we are there, and this is one of the key questions given how pervasive they are. Think about the distortion that it induces from kind of more the asset side rather than liability, free money on the or subsidized money on the liability side.
And therefore, the main actor which could benefit from the quantitative easing is the government, because of course corporates, there is always, at least politically, a certain reluctance to subsidize directly or indirectly corporates, but government is something quite different and may induce government to be more indebted maybe and less cautious when expanding expenditures.
Yes, I think this is a very well posed question, and I think the first question Carol asked, I think when we get to the point of increasing even more sovereign bond intervention, holding of sovereign bonds by the central banks, we're getting very close to the debt monetization regime where the government expenditure are financed by central bank printing money, and that's very risky. Historically, this has rarely ended. So yes, I agree that the risk-taking discussion is often geared towards firms and banks, but that we should, at least equally aware of potential risk with, less reasonable fiscal policy and deficit management from sovereigns as well. Yeah, absolutely. And the point is not supposed to replace, good fiscal logic, but alleviate perhaps financial turmoil like during the euro crisis, right?
Exactly.
But of course, distinguishing between the two and knowing when you go too far or not far enough is the thing that makes this is a big challenge, and why we need more people thinking about that to make sure that we can land on the right level of public intervention without going overboard. But as I said to Carol, I think now we're getting close to the limit. I feel I'm worried that we can go much further without creating these additional bias incentive for lots of different actors.
I think we are going out of the time. I would like, if there is no other question, is there a question? Someone who has not asked the question who would like to ask his question? Please don't hesitate. If there is no further question, I would like, Olivier, to thank you so much for your presentation, your double presentation, because we had the same presentations this morning for those who are more in eastward of Europe. And the current slot is more dedicated for those who are westward of Europe, of course. And thank you so much, Olivier, because what you presented was not only stimulating, but also highly pedagogical. I think everyone has understood what you said and what you clearly explained. And I think it's absolutely key for us to be aware of what you have been presenting and the consequence, because it's at the core. These consequences are at the core of the asset liability management by definition, and of our assessment, at least of financial risk. And therefore, thank you very much. And I encourage everyone to look at the website of Olivier Darmouni. And Olivier, in any case, we will remain in contact following what you are doing, your work, and we will, of course, remain in touch. Thank you very much.
Thank you,
And
Philippe. That's a pleasure. Thanks for everyone in the audience as well. Yeah.
Thank you for the participants. Okay. Goodbye to all.
Goodbye.
Goodbye.
Thank you.